Morning, everybody. Good morning. Thank you, thank you. It's good to see so many familiar faces. It's been a while since been out in the event network, so thank you for taking time on your Saturday to come out. My name is Randy Churchill. My day job is with Avidbank. I'm the managing director of our venture lending, in our venture lending group. And I used to say we're a small version of Silicon Valley Bank, but I don't say that anymore. So, yeah, we do venture lend, as the name implies, we do venture loans to companies that have raised institutional venture capital. So today we're here to talk about what's happening in the industry, venture capital that is, a lot of uncertainty, and I've got some thoughts on my own that I'll share quickly, but more importantly, we have a panel of experts that are going to really impart some knowledge upon all of us. So quick recap on the agenda. We have a keynote presentation from Eric Pakravan. Eric's a partner at TenOneTen Ventures. You may recall, if you were here in 2019, Eric gave a very good presentation when he was with Amplify LA. So this is the updated version. We'll see a lot of changes. I'll just leave it at that. And after Eric, we also have a company presentation by Todd Glickman. Todd is the SVP of Finance and Accounting with Navitas Semi. Navitas presented at this forum, I want to say 2018. Gene Sheridan, the CEO, made a presentation right after their A round, a successful A round. Todd's back to show you a success story. The company's gone on multiple rounds of funding and an IPO in 2021. So while their success kind of went hand in hand with the frothy market that we saw, the lessons learned and some of the war stories Todd will share, I think, are very relevant to today's market as well. After that, we've got 3 additional VCs are going to join us on a panel. Jason Schottler, I don't know if Jason's here. There he is. Hey. Yeah, fantastic. And Lakeisha Landrum-Pierre, I don't see her yet either, but she'll probably come in a few minutes. And then Wilson Kai with Basis Set. So I've got a few questions I want to run by them, and don't get too freaked out. I know the agenda only says 10 minutes for audience Q&A, but I know you have more questions than 10 minutes will allow for, so I will cut my questions short to make sure all of you get a chance to ask the panelists questions. Quick shout out before we jump in, a couple housekeeping items, but the Enterprise Forum, sorry, it's now the Entrepreneurs Forum, has been around since 1984, so we're coming up on our 40th year. I've been involved almost 20 years on the committee, but we have some committee members that have been here from the outset. So this, what you're looking at, is a list of all the committee members. I just want to ask those who are here today just to stand up or raise their hand. We got Russ and Stan and Lynn. I think, is Ira's still out in the lobby? Because I think Ira's been here from day one, right? So that's fantastic. So it's a great organization. If you're at all interested in getting involved or would like to sponsor, please talk to Stan at the break. Speaking of sponsors, just want to acknowledge EY, Louis Rocca, Avidbank, and then Michael Nilsson, and in memoriam, Nick Nichols. Nick was integral in the forum from the get-go, and was the Industrial Relations Center at Caltech for a number of years, but he passed in the last year, I believe. Our design group is Cluj, and our innovation supporters Innovate Pasadena. So thanks again for all the support. Just so you'll have it, our social media handles. And a quick nod to our upcoming events. Commercial Space, May 20th. Typically, we delve deep into a sector, and this program today is what I call horizontal. That obviously funding applies to all sectors. So if you want to come and learn a lot about commercial or new space, I invite you to join us on the 20th. Just filling out the program, so send you to our website for details as they develop. Also would ask, before you leave today, please scan this QR code. It's a very quick survey. We just want to know what we're doing right, and probably more importantly, what we're not doing right. If you have any bad tweets or bad surveys, just keep those to yourself, though, please. Oh, actually, before I go to recent headlines, I want to take a quick survey live here. So by show of hands, how many of you are entrepreneurs or kind of entrepreneurs in transition who think you're going to raise funds or you'd like to raise funds? Oh, that's fantastic. Very good. How many of you have successfully raised funding already? Okay, so the first group, spot these people and come ask them how they did it. Students, Caltech or otherwise? Okay, so a few. And then how about advisors, lawyers, bankers, people like me? Fantastic. And then how many of you have attended the forum in the past? Good, strong following. And how many of you happen to be here in 2019 when Eric gave his update? Well, good. Fantastic. So thanks again for coming back. So, Lakeisha, hi there. Come grab a seat. There's plenty down front. So when we talk about uncertainty in venture funding, if you were here for Eric's presentation in 19, that was right at the beginning of the run-up that peaked in 2021. There was 10 plus years of almost negative or almost zero interest rates, and lots of money, lots of companies got funded, probably lots of companies that shouldn't have been funded got funded. And what we're seeing now with the rise in rates, international turmoil, recessionary times, there's been a sharp decline, and we'll delve into that in a few minutes. And I did, as I was preparing this presentation last night, I threw it into ChatGPT, so I don't even know what it says, but we'll see in a minute. But I also Googled venture capital downturn, and I came up with some recent headlines. So the first one was actually not from now, it was from May of last year. The venture slowdown isn't coming, it's here. Getting to Series A has gotten harder. Venture capital valuations drop, down rounds rising. The exit market is terrible, it's down more than 90%. And then more recently, and near and dear to my heart, is SVB collapse as a double whammy for tech startups. So there's a lot of stuff going on that doesn't bode well for funding a new company. In fact, if you look at the data supports it as well. So a little bit hard to read, but the top bar graph shows deals quarterly, and you can see the peak in 2021 right up here. And then each quarter since, the green bars or the aqua bars represent the dollar amount funded, and then the line is the number of deals. They're both on a pretty precipitous decline. And then the middle bar graph is actually the exit value. And why is exit value important? That's why VCs are in the game. They invest to get a distribution when your company does a big IPO or gets acquired. They typically don't want just get their money back or a 2 or 3x. Most of them want the 10x plus. So exit value drives valuation of new companies getting funded, thus drives the amount of money that goes in. So exit values are way down. The IPO market is almost non-existent. And then the last one on the bottom, that actually shows the amount of money that venture capital funds raise from their limited partners to put into ventures, so the top of the pipeline. So all three don't look great. And you might say, well, that's great, that top set just shows all deals, but those are later stage deals. Early stage deals are still getting funded. Well, if you look at Crunchbase, this actually shows the same trend, but also by stage. So the dark on the bottom is angel seed rounds, the baby blue in the middle is early stage deals, and then the top is later stage deals. So across all stages, venture funding has been coming down. So I don't want to turn this into a big downer conversation, and it's not. It's not, trust me. We've got some people here who are going to pick me up when we get them up on the stage. But just anecdotally, so we've seen some headlines, we've seen some data. Anecdotally, here's what I've been hearing on the street. It'll improve later in the year. I don't know what year, because I heard that last year, and I'm hearing it again this year. But people have this sense that Q3, Q4 interest rates will settle down. We'll see the market come back. Always hear the good companies will still get funded. It's those bad companies that shouldn't have got funded. Many great companies were started during a recession. I heard this back in 2000 when the dot-com bubble popped, and the example was always, FedEx was founded during a recession, and just keep at it, you'll get funded, a lot of good companies. High valuations aren't good for startups. All they do is set the bar too high for the next round, and then you have to take a down round. There's lots of dry powder. Dry powder is the amount of money that limited partners have to invest in venture capital. So it's called this overhang. There's all this money out there just waiting to go into the system. And therefore VCs have to deploy it. They're holding on to it. Well, we'll ask them today, are you sitting on a pile of cash that you must deploy? You know, it's healthy to cull the herd. There's a lot of companies, again, that shouldn't have got funded. Is that Stan out there ringing the bell? You know, you know, let's cull the herd. You know, kind of clean it out. We do a little bit of a refresh or a restart. And then the other thing I hear quite often is, hey, you're an early stage company. Just put your head down, your nose to the grindstone. Don't get caught up in what's going on in the macro economy, because by the time it's going to matter to you, the economy is going to be back. You know, right now, focus on getting your product to market and developing what's important, and then worry about what's going to be happening in 2-3 years down the road, in 2 or 3 years. So with that, those are kind of my thoughts, and I'm as anxious as you all are to hear kind of where we're headed. So I'm going to introduce, again, our first keynote, and it's Eric Pakravan, partner with TenOneTen Ventures.
Randy, yeah, thank you again for having me back. The 2019 presentation was, I'd been doing it, like I did in 2016, 18, 19, and it was kind of like the same story every single time, and now this time, like, you know, the last 4 years. It's been an interesting time, and so I'm happy to be back, and yeah, I think the last one started off with a slide kind of similar to the kind of just macro US stuff, and we had finally reached in 2019 like the same amount of venture funding in LA that we had in 2000, and the big headline that I had made was, you know, 2019 is not 1999, and it wasn't, but apparently 2021 was. Which you'll see in these numbers. So, you know, I thought what I might do, just to kind of put it in perspective, because there has been so many changes, is actually just go back and give a longer term view of kind of what kind of the LA tech scene has looked like, boom and bust cycles kind of in the past as well. And also really kind of hoping to just track the talent, right? I mean, kind of the LA and just Southern California tech scene really is about, you know, people and, you know, having, you know, the person who succeeded in the past and knows how to build technology, and the customers and the LPs and the investors and kind of that entire ecosystem kind of all working together. And you know, what we've really seen in the last few years has been kind of a snowballing, just the snowballing effect as, you know, just more activity creates more activity. So I'm going to start all the way at the beginning, in 1969. Unfortunately, it was at UCLA, not it should have been at Caltech. But you know, kind of the internet has its roots here in LA, and you know, the key thing to remember there is like that has to do a lot with kind of initial defense spending. Driving kind of the initial engineering base that existed here, again, over 50 years ago. So kind of that goes to this slide a little bit. You know, actually it started a little bit kind of earlier than the Cold War era. I mean, World War II really, that picture that you see on the left, right? Yeah, the track homes. That was like the big mobilization during World War II, where, you know, aerospace and kind of, you know, jets, airlines, missiles, all that sort of stuff was being developed here, and so we needed to house people. And at its peak, there was 2 million people working in the aerospace industry here in LA, many of them engineers, and that's continued. I mean, the thing to know, which is, you know, I find fascinating, is like you think about LA as kind of, you know, Hollywood drove the economic development of LA, and that's true. It was a contributing factor, but the defense industry and aerospace were far more impactful to the city. The like Lockheed Martin set up their kind of headquarters in Burbank, again the same year that Warner Brothers set up their headquarters in Burbank as well, and then employed far more people. And then obviously Caltech here, you know, had a lot to do with the kind of initial build-up of kind of an engineering talent base here in LA. JPL was founded because of the talent that existed here at Caltech, not too far from here. And again, it predated the development of NASA. Eventually, kind of NASA swallowed up JPL in the 1950s, but kind of JPL has been here for yeah, almost 100 years now. And you know, kind of that middle piece right here. You know, you kind of think about the internet. You know, obviously we know the history was kind of ARPANET and all of that, but really it was, we thought when Sputnik went up that the Russians might somehow attack our long distance phone lines, and the kind of defense industry needed a way to communicate, and so that was kind of what kind of drove the push to develop something like the internet, and now kind of obviously it's commercialized and become far more important. I'll stay here for one quick second. I mean, I think what's really interesting also about LA is the crash that LA had in the early 90s, far more than most other cities. Like when the Cold War finally ended, there was just an evaporation of spending here in the early 90s. We had almost 10% unemployment in LA, and that was just far worse than kind of other West Coast cities. San Francisco fared far better, so did Seattle. But then, kind of by the late 90s, again, big kind of Caltech related push here is, World Wide Web kind of finally came into fruition in 1994. And, this was one of the major kind of activity hubs of kind of that, 90s, dot-com boom. Idealab being the biggest name. I think, as important as kind of Y Combinator is on the accelerator side, this was before accelerators existed. Idealab, like Picasa came out of Idealab, and so did Overture that you see on the bottom there. iRobot, just a bunch of companies, and then many fast followers came and tried to copy Bill Gross and create their own versions that kind of worked in maybe not so great or great ways, but Idealab has been kind of the premier incubator, really. Kind of ever. And then a lot of other names, right? Like Applied Semantics developed AdSense, and then that was sold to Google early on, became kind of Google's LA office. eToys, I just put that here because it's like a big, it's kind of one of the poster childs of companies that maybe shouldn't have been funded at the time that got funded, and kind of is made fun of for many years thereafter. But if you look at these, I mean, like Overture, Applied Semantics, those two, the acquisitions to Google and Yahoo, right? They became their advertising arms here in kind of Southern California, and kind of as I talked about building this base of talent and kind of interconnectivity and all of that sort of stuff. Former executives who then worked at Yahoo. And Google here in LA kind of often went on kind of in later years to start kind of many companies, many VC firms. So this is the bust times. Then it all went south. One of my partners at Amplify was one of the co-founders of TrueCar, and he saw this data, I don't know, some years back about kind of the 2001 through 2009. Funding stats, and he just stared at it. He goes, "That was a dark time." And as you can tell, I mean, like Randy was talking about, like, when will it come back? I mean, it could last a whole decade. It could also come back, tomorrow. I mean, not trying to predict the economy, but right, like the key thing here is, there were still kind of big companies that were built in that time. SpaceX, great example of a company that kind of was able to pick the pieces of that, like kind of all the aerospace talents and infrastructure that had kind of not been touched for 15 years. And that kind of is why they've been able to succeed here. MySpace is a really interesting one. I mean, I think if I go back 10 years ago, the companies that we were meeting in LA that were starting, and raising their first round of capital, I would say I met like half of them, if not more, had a co-founder that could trace themselves back to MySpace. And that's because MySpace was like, it was the first Facebook. It was before Facebook. And a lot of people moved to LA to go take, their first engineering job or their first PM role at MySpace. You also had kind of the executives, right? The founders of eUniverse, which kind of MySpace was a part of, also made money on MySpace, went off to go start VC firms and start investing and starting their next companies. And so that, I think the implosion of MySpace, in a way, kind of really kind of catalyzed a lot of the startup activity in the decade thereafter. But also, if I go back one slide, Overture, that's the other one. again, this is anecdotal, just from my own kind of, just interacting with founders, but a lot of ex-Yahoo people were kind of that first kind of set of like, oh, you've seen it, you've been inside of a tech company, you've been inside of a startup, who can we back locally? Now, kind of as I jump forward, right, like there's, Honey right now, is acquired by PayPal for $4 billion. There's a lot of people who've now vested and are leaving, and that's kind of another MySpace moment where there's a lot of talent who've seen growth and have worked with big teams and have, Service Titan, again, I can't, tell you how many companies I've met who, are ex-Service Titan employees, executives who are starting their next company. So many, many more of these companies now kind of have talent that hopefully will feed kind of for the next decade and maybe longer. So then we got the 2010s, and the 2010s, it's, I think driven by, as Randy said, right, like a booming economy, low interest rates for much of that era, kind of allowed investment capital, but also, two key technologies really kind of helped LA specifically. It helped all startups, across the country, but specifically, cloud, which I think we think about LA as a consumer base and all that sort of stuff, but really this notion that you don't have to build in the Bay Area because you don't need to build your data center the minute that you hit scale was a really transformative kind of moment. Facebook is the famous example here where they were in Boston. Again, Boston has a lot of technical, talent, has been a technology center for many years, but they famously moved to the Bay Area because, again, they had hit so much scale that like building the infrastructure to support literally their servers just didn't exist. They couldn't hire that talent as easily in a city like Boston, and a city like LA was like far less suited to support that. So kind of AWS, cloud, all of that sort of stuff, being able to build right, like, and on on Amazon or Google or Microsoft or IBM servers, and allowed companies to all of a sudden kind of get built where people wanted to live. And apparently people like to live by the ocean because this was the Represent LA map of startups 11 years ago, kind of when Silicon Beach, if you want to call it that, started to kind of get moving. Right, there was this all of a sudden, kind of increasingly interconnected ecosystem that was developing in Santa Monica and Venice, and still very much exists today. But I'll say kind of it's definitely kind of grown to encompass far more of LA as kind of companies have grown out of that space. Right, Snapchat again here also benefits, right, from this cloud, cloud boom, if you want to call it that, right? Like Snapchat is still on Google's cloud. They don't have their own data centers, and that was possible when they were founded in 2011 in a way that wasn't possible when Facebook was founded in 2004. The other thing, again, that really supported LA is mobile, right? Specifically consumer mobile, and so that's kind of why like Snapchat, Tinder really both kind of changed the name of the game for social dating, social media, all that sort of stuff, and that kind of connectivity to just a bigger and more diverse, kind of more media savvy market, and I think was a big factor there. So here's the data. This is the low interest rates fueled growth that you see on the right, but also again, the low interest rate can fuel kind of investment in a lot of categories. Why tech? It's because there's something to be investing in tech, especially in this period. And the two technologies that stick out to me in that period were, again, mobile cloud, and first the startups come, then the VCs come. And so here's all your investors who set up shop in LA kind of in that decade. Now, if I fast forward a little bit, I can probably double this, double the number of names here that have started in now this decade, which I'll get to that. But essentially, right, like we went from having under $1 billion under management here in LA to, again, many times that by the end of the decade, and as you'll see, it went way crazier thereafter. All right, so now we're at today. And I mean, I think really the remarkable thing about 2020 is how how much it resembled 2019 in aggregate. But if you look at every single quarter, each quarter that year was completely different. I mean, we were starting to hit records in the first quarter. The second quarter was essentially frozen until kind of May, June. Summer, I think people started to realize, hey, we can invest again. And then all of a sudden we started to hit like insane records by Q4, but in aggregate, it kind of looked like 2019. The real, but that kind of end of the year boom, really kind of carried through all the way through 2021. And that's kind of what you're seeing on all those numbers at the bottom there. And then, what's interesting is, again, Randy, kind of your numbers show, a nice drop in funding, and that kind of nationally, and that matches in LA, right? Like, kind of we're trending, again, assuming things keep on pace with Q1, we're trending down in terms of funding that kind of SoCal companies are raising. The number of new investment vehicles that kind of have been raised so far this year are kind of trending way down. The one thing that's remained stable, which kind of this goes back to this dry powder piece, has been valuation so far. I don't believe that it'll stay as stable as it looks. That's a lot of flat rounds. That's a lot of companies that raised a lot of money in 2021 that aren't going out to market, and if they did go out to market, would be raising at way lower valuations. That's a lot of bridge rounds as well. Let's say you've made a lot of progress. You're just shoring up your kind of balance sheet essentially for winter, and nobody wants to take the loss yet, and so that's kind of keeping valuations, at least on average, high in LA. But it's inevitable that will fall. I actually think, again, if I did make a prediction, kind of Randy, you're like, I think you made the comment that you kind of heard on the street that valuations are interest rates might get back to normal again later this year, and funding will come back and all that sort of stuff. I think that the kind of inevitable thing is a lot of companies are going to need to go back to market at some point. That's going to have to start, I don't know, later this year or next. At some point, companies that had shored up their balance sheets, let's say in kind of May of 2022, if they got 12 months or 24 months or whatever, right, that timeline ends. And so that's kind of the big question mark on my kind of in my head, is kind of what happens when they all go out to market. But yeah, anyway, it's been an interesting time, and I think for VCs, kind of navigating investing during this time has been a tricky one, and it's also been kind of tricky for companies. So that's cut in a few ways. For the on the investor side, right? I mean, 2020 was just the rogue year in many ways. People were trying to figure out, can you invest remotely? Can you invest in someone without meeting them? The answer to that largely was people did, and people, figured out kind of ways to kind of adjust their process. What was more of a change was just the speed. Investors had to figure out how to do diligence at a rapid timeline, otherwise they were sitting on the sideline. And then that was very quickly followed by just insane valuations. And so kind of investors were trying to decide, do I invest in this company that I think is really great, or do I kind of sit it out? And so a lot of those decisions were made during that time, and I think investors now need to unlearn a lot of the kind of best practices about kind of how they thought that they were investing at that time. For founders, really it's around talent, I would say, has kind of been the biggest shift here, right? I can't tell you how many of our companies were complaining throughout 2021 and 2022 that they just can't hire engineers. And when they did hire engineers, they were hiring them all over the country because, again, nobody was working in office. And now suddenly, that's changing. I mean, now you can hire an engineer, but you're maybe not trying to make that expensive hire because you're trying to keep your balance sheet healthy. And on top of that, you're choosing to hire locally again in a way that wasn't really happening kind of in 2021, early 22. So All right. Let's see how we're doing on time. Yeah, we're doing great on time. All right, I'm going to spend some time on this slide. It's my favorite slide. Yeah, I mean, LA is a really interesting and unique city that really doesn't resemble most of your other major U.S. and international cities. I mean, the headline here is we have $1 trillion local economy. I think we hit that finally in like 2019. And we're the third largest globally. I mean, there's like Tokyo, New York, and then there's us. And then if you look at that kind of where you see Walt Disney on the right, we have like no Fortune 500 companies. Like I struggled to put that list together. And every single time I did find the Fortune 500 company, they've like now moved out of LA, or at least they've relocated their headquarters. And that's to me really interesting because again, unlike New York City, where you've got the headquarters to almost every single media company that's actually based in LA is headquartered in New York. You've got all these major corporate offices, even in cities like Seattle, the Bay Area, right? It's far easier to find kind of major companies of note. Not so much in LA, and yet our economy is larger than almost every other kind of metro region in the world, and that's again kind of more to the point that this is a SMB and mid-market city. We're really a self-sustaining ecosystem in many ways, and that kind of puts LA in a unique position when it comes to like the types of companies that get founded and funded here. So that that graph that you see on the right that looks kind of pretty diversified. I mean, I'll note. So that's based on employment, not GDP. So if you looked at that again, based on kind of how much of an economic impact you'd have there. Obviously, media entertainment would be bigger than its 3-4%. Tech is obviously bigger. Finance is a little bit bigger. Kind of areas like education, government, that sort of stuff are just overrepresented here because it's really about kind of people, not economic impact. But it's still fairly. I mean, this was the richer data, so I put that here. But it's still fairly diversified. I mean, I think it's surprising how small entertainment is in LA, just kind of given that we're known for that. And so kind of that, what that means is essentially, as you look at the companies to the left that, have done well here, one, they're pretty diversified. I mean, you're seeing like companies from space to, media to fintech, real estate tech, big consumer, kind of mobile and all that. But then you're also seeing a lot of vertical SaaS, like that's Boulevard, that's Service Titan, that's companies that are able to sell to, again, that, logistics company, that trucking company, that, beauty salon, whatever it is. ZipRecruiter, same thing, right? Selling heavy into SMB. It's every single company that needs to hire and kind of needs to figure it out on their own and doesn't really have like a big HR team. And so kind of the B2B opportunity in LA has increasingly become kind of much more industry connected than you see in a city like SF where you're selling into the Fortune 500 that actually exists there, and that's kind of where those customers are. A lot of department-specific software, selling into accounting departments, selling into sales departments, selling into engineering orgs. LA is much more selling into industry than you see elsewhere. And then the other side of this coin is just this kind of big population base we've got here. That makes it, a lot, just a lot more favorable to start a consumer company, down here. And so kind of you see that kind of over and over again. This is an interesting slide. I started kind of tracking kind of the top 10 rounds in LA. I don't know, let's say like 2017, I would like pull together this list and, and it was like, you needed like, maybe to raise 50 million to make it in the top 10 of like an LA top 10, fundraise for the year. And now it's like, $200 million baseline the last couple of years. So it just shows you like that's how much money has gone into the system. And it's, the SpaceX is an interesting one. Are they a startup? They're a private company? Who knows? But kind of if you look at the bottom of this list, that's kind of where it's interesting, right? Like there's a few companies that in the last couple of years, Age of Learning is one of them. What was the other one here? Now I'm forgetting. There's one other here. Oh, Kajabi is another one that have been around for a while, haven't really raised much, and then all of a sudden kind of came out of the gate and just took advantage of the great kind of favorable economy and just took in a bunch of money for growth. And kind of they then also joined kind of companies that have been like joining this list like year after year. Jam City is one of them. I think they've made the list many, many years in a row because it's just a high, capital intensive driven business model. I kind of wonder how companies like that kind of will fare, kind of as capital becomes harder to raise. Scopely is another company that was on here many times. Also, similar to Jam City, was a mobile gaming company. They finally sold for $5 billion a couple weeks ago, which I think was a good move because their whole model worked, and in an era of kind of easy to raise capital that seems to be going away. All right, so the graph on the right, Randy, that's what you showed. It was that final chart where you're like, look at U.S. VC, funds. This is LPs putting money into VC funds, and that last, 2023 piece is Q1 of 2023 so far. So I don't know, even if you multiply that by 4, it's still kind of falling off of a cliff. Here, the graph to the left is LA, and there's a couple things here that are really interesting. One is, I think it kind of confirms what at least I've observed over the last few years, which is like if you were in 2014, there were no big funds in LA, and that was the biggest problem. You had to leave LA at a certain point. You might raise your pre-seed in LA, but then you would raise your seed round from Bay Area investors. You might raise your seed round in LA, but you're going to definitely go to the Bay Area because there's only 2 VC firms in LA that could lead a Series A round, right? And that started to change, again, very slowly, kind of over the last decade, and then kind of very rapidly in 2021, 2022. And kind of even in this year so far, kind of mega funds in LA have continued to announce new funds. And so that's a good sign that side is picking up. What's really concerning is the drop in the early stage, the sub $100 million funds. I think the data is just old. I don't know. We're a fund in the $0 to $100 million range, and we'll be announcing a new fund later this year that's also going to fit into that. Kind of many of our peers also are. So I just think it's harder to get data from smaller companies. Or smaller funds, it comes out later, so TBD there. But again, right, this drop in LA, right, like at the moment, LA is on pace to surpass 2022, and we'll see if that happens. But again, not as stark as what's happening nationwide. Capital seems to have come to LA and is staying here a lot more. All right. So really quickly, share a little bit about TenOneTen and myself. So we are a firm founded in 2014, really around supporting technical founders, which was a novel concept in 2014 because the whole perception of LA was, and in many ways still is, that we're a consumer town and it's very media centric, and hard tech isn't being built here, and we wanted to kind of change the narrative and really kind of prove that, look, big kind of tech driven companies can be built in LA, and that's exactly what we've done, and kind of over time I would say what's become again, it was not kind of where we initially set out, but it's become increasingly more and more of a common theme for us, has been kind of investing at that intersection of kind of major underserved industries, a lot of logistics, a lot of healthcare, a lot of real estate and construction, a lot of manufacturing, and bringing technology, data, AI to those industries. I think that's just the very, kind of as I've kind of shown in the presentation, it's just a very LA story. And then lastly, just because Lakers are playing tonight, thought I'd end with this quote. Yeah, it was kind of one of the final kind of things that Kobe said. And he was talking about LA. So I think LA is a great city, and I'm glad that, again, many of you, it seems like, are entrepreneurs here, are building, in this ecosystem. So thank you.